Credit can feel like the secret scorecard deciding how easy or expensive life will be. Let me tell you about Alex. At 22, Alex had no clue how credit worked. A couple of late payments on a store card, an impulsive phone upgrade, and suddenly their score was in the poor range. Renting an apartment? A nightmare. Even getting a phone plan meant paying big deposits. For years, Alex thought they were just unlucky. But one day, they decided to figure the system out. They learned the rules, started paying on time, kept balances low, and chose the right credit cards. Slowly, their score climbed. Within 2 years, Alex went from poor to excellent. Suddenly, car loans had low interest rates. Landlords stopped hesitating, and rewards points started piling up for free flights and hotel stays. Here's the truth. Credit cards can be dangerous if you use them blindly, but they can also be one of the most powerful financial tools you'll ever have. Used right, they can help you build credit faster, earn serious rewards, and give you protection that cash or debit never could. The key is knowing exactly how to play the game. In this video, I'll show you how to raise your credit score fast, how to rack up rewards without overspending a single dollar, and how to sidestep the costly mistakes that trap so many people in debt. By the end, you'll have the same blueprint Alex used, and the confidence to turn credit from something you fear into something that works for you. A credit score is basically your financial reputation in a single number, a snapshot of how trustworthy you are when it comes to borrowing money. Lenders, landlords, and sometimes even employers use it to decide whether they should take a chance on you. The higher the number, the lower the risk you seem, and the better deals you'll get on loans, credit cards, and even rental agreements. A low score, on the other hand, can mean higher interest rates, bigger deposits, or straight-up rejections. It's not just about borrowing money. It's about making life more affordable. Now, not all credit scores are the same. The two most common scoring models are FICO and VantageScore. FICO is the one most lenders use, while VantageScore is becoming more common with free credit monitoring apps. Both range roughly from 300 to 850, but they weigh certain factors slightly differently. The good news is the basics of building a good score work for both. Here's what actually shapes your score. Payment history. This is the most important factor. Lenders want to see if you've paid your bills on time every time. Even one missed payment can hurt, and the damage can linger for years. Credit utilization. This is the percentage of your available credit you're actually using. If you have a $5,000 limit and carry a $2,500 balance, that's 50% utilization, and that's high. Experts suggest keeping it under 30%, ideally under 10%, to show you're responsible with credit. Age of accounts. Lenders like to see long-term relationships. The older your accounts, the better, because it shows stability. That's why closing old credit cards can actually hurt your score. Credit mix. This is about variety. Having only credit cards isn't bad, but a mix of revolving credit like cards and installment loans like car loans or student loans can give you a small boost. Hard inquiries. Every time you apply for credit, the lender pulls your report, and that's called a hard inquiry. A few are fine, but too many in a short time can signal risk and temporarily lower your score. When you understand these 5 factors, you can see exactly where to focus to improve your score, and more importantly, avoid moves that could quietly drag it down. FICO scores are the gold standard for most lenders, and they're calculated using a specific formula that turns your credit history into a number between 300 and 850. The breakdown looks like this. Payment history, 35%, credit utilization, 30%, length of credit history, 15%, credit mix, 10%, and new credit inquiries, 10%. Payment history carries the most weight because lenders want proof you'll actually pay them back. Utilization is next, since maxing out cards can signal financial trouble. The length of your credit history shows stability. Your mix of accounts shows experience with different credit types, and inquiries show how often you're seeking new credit. There are a lot of myths about FICO. One big one is that carrying a balance helps your score. It doesn't. In fact, paying in full every month is best. Another myth is that checking your own score will hurt it. That's false. Only hard inquiries from applications impact your score. Some people also think you need debt to build credit, but you can build excellent credit while avoiding interest charges entirely. When lenders see your FICO score, they interpret it as a risk rating. Scores in the 300 to 579 range are considered poor, meaning you're high risk. 580 to 669 is fair. You might get approved, but expect higher rates. 670 to 739 is good, meaning you're a lower risk and can get decent terms. 740 to 799 is very good, where lenders compete for your business. And 800 to 850 is excellent, the level that unlocks the best rates, top rewards cards, and premium perks. The jump from good to excellent isn't just about bragging rights. It can save you thousands over the life of a loan and give you access to the most lucrative credit card rewards programs. Knowing exactly how FICO is calculated lets you focus your energy on the areas that matter most. So you're not just improving your score. You're strategically aiming for the range that changes your financial life. Credit cards are more than just plastic in your wallet. They're short-term loans you can use for purchases with the promise to pay the balance later. Every time you swipe, tap, or enter those numbers online, the bank is fronting the money for you. If you pay it back in full by the due date, you avoid interest entirely. If you don't, that's when the interest kicks in, and it's usually not cheap. A few key terms are essential to understand. APR stands for annual percentage rate, the cost of borrowing money if you carry a balance. Most cards have APRs in the mid to high teens, or even 20% plus, so carrying a balance can get expensive fast. The grace period is the time between your statement date and your payment due date. Pay your balance in full during this time, and you'll pay zero interest. Your statement balance is the amount you owed as of the statement date, while your minimum payment is the smallest amount you can pay to stay in good standing, but paying only the minimum means you'll pay interest on the rest. There are different types of credit cards to fit different needs. Secured cards require a cash deposit and are great for building or repairing credit. Unsecured cards don't require a deposit and are what most people carry. Then there are rewards-focused cards. Cashback cards give you a percentage of your purchases back as cash. Travel cards earn points or miles for flights and hotels, and some combine both. Premium cards, like the Platinum from Amex or Chase Sapphire Reserve, come with high annual fees, but also premium perks, airport lounge access, travel credits, and elite hotel status. Understanding how credit cards work, the key terms, and the types available is the first step to using them as a tool instead of a trap. When you choose the right card for your goals and pay strategically, you can enjoy the benefits, from building credit to earning rewards, without falling into debt. Reward programs are the fun side of credit cards. They let you earn something back for the spending you already do. Every purchase earns either points, miles, or cashback, depending on the card. Points are flexible credits you can redeem for travel, gift cards, or statement credits. Miles are usually tied to airlines and can be redeemed for flights, upgrades, or partner travel perks. Cashback is the simplest. You get a percentage of your spending back as cash or a credit on your bill. Many cards offer category bonuses, meaning you earn extra rewards for specific types of purchases like dining, groceries, gas, or travel. Some cards even have rotating categories that change every quarter. Activating these can mean earning 5% back instead of the standard 1%. If you want to really maximize rewards, learn to stack them. That means combining multiple reward opportunities on a single purchase. For example, you could click through a credit card's online shopping portal to earn extra points, pay with a card that offers a category bonus, and use a promo code from the store, all on the same transaction. Then there's travel hacking, the art of using points and miles strategically to get flights, hotels, and upgrades for a fraction of the cost. This often means signing up for cards with big welcome bonuses, timing your redemptions for high-value trips, and transferring points to airline or hotel partners for maximum value. For example, 50,000 points might get you a $500 statement credit or a $1,200 business class flight if you transfer them wisely. The key to maximizing rewards isn't spending more, it's spending smarter. By choosing the right cards, using them in the right categories, stacking offers, and redeeming points strategically, you can turn your everyday expenses into free travel, cash, and perks you'd otherwise pay for out of pocket. If you want your credit score to climb fast, you have to focus on the actions that move the needle the most. The number one rule is simple. Pay every bill on time, every time. Even one late payment can stay on your report for years and drag your score down. Setting up auto pay or reminders can make sure you never miss a due date. Paying in full also saves you from paying interest, which keeps your debt manageable and your finances healthier overall. Next is credit utilization. How much of your available credit you're using. Aim to keep this under 30%, but if you really want to boost your score, try staying under 10%. That means if you have a $5,000 limit, don't let your balance go over $500 before your statement closes. You can lower utilization by paying mid-cycle or requesting credit limit increases. Another quick boost can come from becoming an authorized user on someone else's well-managed credit card. If a family member or trusted friend has a long history of on-time payments and low utilization, their account history can be added to yours, instantly improving your profile. Diversifying credit lines is another step. If you only have one credit card, adding an installment loan, like a small personal loan or auto loan, can help show lenders you can handle different types of credit responsibly. Finally, if you have negative items on your report, you can work on removing them legally. This might mean disputing errors with the credit bureaus, negotiating with creditors to remove a late payment in exchange for settling a balance, or simply letting older negative marks age off your report. Building and improving your score isn't about quick gimmicks. It's about consistent, smart habits. The sooner you start these practices, the sooner you'll see results, and once your score rises, the benefits, lower interest rates, better rewards cards, and more financial freedom will follow naturally. Credit card debt is one of the most expensive kinds of debt you can have, and it can trap you faster than you think. Most cards come with high interest rates, often 18%, 20%, or even higher. That means if you carry a balance, the interest charges can snowball quickly, turning a small balance into a big problem. The best way to avoid this is simple. Pay your balance in full every month. If you already have debt, you need a plan to get rid of it. Two popular payoff strategies are the snowball and avalanche methods. The snowball method focuses on paying off the smallest balances first, which gives you quick wins and motivation to keep going. The avalanche method targets the highest interest rate debt first, which saves you the most money in the long run. Both work. The best choice is the one you'll stick with. You also need to watch out for predatory offers. These can be cards with high annual fees and low benefits, credit repair services that charge for things you can do yourself, or balance transfer offers that hide massive fees in the fine print. If something sounds too good to be true, read the terms carefully before signing up. And here's a trap that catches millions: minimum payments. They might keep your account in good standing, but they barely touch your principal balance. Paying only the minimum can stretch repayment into decades and cost you thousands in interest. For example, a $3,000 balance at 20% APR with only minimum payments could take over 15 years to pay off. The bottom line is that credit cards should be tools, not crutches. If you understand the risks, avoid carrying high balances, choose your cards wisely, and have a plan to pay down debt fast, you'll never fall into the traps that keep so many people stuck for years. Premium credit cards like the Amex Platinum, Chase Sapphire Reserve, or Capital One Venture X come with high annual fees, sometimes $400, $500, or even more, but they also pack in perks that could be worth far more if you use them strategically. One of the biggest draws is airport lounge access. Instead of waiting at the gate, you can relax in a quiet space with free food, drinks, Wi-Fi, and comfortable seating. Some cards also include concierge services, which can help you book hard-to-get restaurant reservations, secure event tickets, or plan travel itineraries. Then there are insurance perks built right into the card. This can include trip cancellation and interruption insurance, lost baggage coverage, rental car collision damage waiver, and even emergency medical evacuation coverage when traveling abroad. These protections can save you thousands if things go wrong on a trip. Many premium cards also offer travel protections and statement credits that offset the annual fee. For example, you might get up to $300 in annual travel credits, TSA pre-check or global entry fee reimbursement, or credits for ride shares, streaming services, or dining. The key question is, when is a high annual fee worth it? If you travel often, Use the statement credits every year and take advantage of the lounge access and insurance perks. The value can easily exceed the fee. On the flip side, if you rarely travel or forget to use the benefits, you're just paying for a fancy piece of metal in your wallet. For example, one traveler used their Sapphire Reserve to book a $5,000 trip, then had to cancel last minute. The trip insurance from the card refunded the full amount. Another used Amex Platinum's lounge access on 12 flights in a year, saving hundreds on airport meals, plus $200 in airline fee credits, easily covering the annual fee and more. Premium cards are best for people who travel regularly, know their perks inside and out, and are willing to use them consistently. If you want to walk away from this video with a clear game plan, here's a simple 90-day roadmap to start boosting your credit and racking up rewards. In the first 30 days, check your credit reports from all 3 bureaus. You can get them free at annualcreditreport.com and look for errors or outdated negative items to dispute. Set up auto pay on all your bills so you never miss a due date. And if you're carrying balances, aim to pay them down below 30% utilization. In days 31 to 60, apply for a card that fits your goals. Maybe a cashback card if you want simplicity, or a travel rewards card if you're aiming for free flights. Use it only for purchases you are already going to make and pay it in full each month. If you already have solid credit, consider a card with a sign-up bonus that you can meet without overspending. In days 61 to 90, explore ways to maximize rewards. Activate bonus categories, use shopping portals, and start tracking your points or miles in one place. If you're rebuilding credit, this is the time to request a credit limit increase or consider becoming an authorized user on a trusted person's account. Here's the most important part. Credit should build your wealth, not your debt. The perks, rewards, and better rates are only worth it if you're never paying unnecessary interest. Carrying a balance to earn points is like paying $100 to get $5 back. It doesn't make sense. So start small, stay consistent, and build momentum. You don't have to dive into premium cards, travel hacking, or advanced strategies right away. Begin with safe, simple habits. Pay on time, keep balances low, and choose the right card for your lifestyle. Over time, those habits will stack up, and you'll look back amazed at how far your score and your financial confidence have grown.